Hello, everybody. I'm Eric Nelson. I'm with Silicon Valley Capital Funding. I've been in the lending business now for 34 years. And frankly, the biggest issue that clients have in any loan process is the credit. So when we talk about your credit scores, they're evaluated from 350 all the way to 850. So when a credit agency like Experian, TransUnion, or Equifax gives you a score, they're evaluating everything about your credit report. When the score is low, that means you're going to pay a higher interest rate or you may not get a loan at all. When the score is high, you're going to get the very best interest rates that that lender has to give you. Again, because a 350 to 850 range exists, there's a lot of variation in how you're evaluated. Most lenders use 620 as the minimum score for them to even consider making a loan to you. In our mortgage industry, you need to be 700 or higher in order to get a decent rate, or what I would call a market standard rate. The three companies that evaluate you, Experian, TransUnion, and Equifax, will allow you to get one copy of your credit report for free every year. You can also get freecreditreport.com and get one annual credit report per year as well. I find it's really important for you to verify your information constantly. These days, many banks and credit cards will also give you your credit score on their actual monthly statement or in the online access to their portal. When you get that, take a look at that credit score and see if it looks accurate to you. Again, if you're over 620, it means you've at least got good enough credit to probably get some kind of loan. If the score is over 700, you're in a very good category. And if you get to the 760 and above, you're in top tier category, which means you're going to get the very best interest rates. So when I talk with people who aren't in that top tier or are not in the 700 or better score, what we usually do is take a look at their credit report to find out if everything on the report is accurate. If you paid a cable bill late, it's likely, or if you didn't pay the bill at all, it may show up as some sort of collection. So collections are, of course, very bad for your credit. If you're more than 30 days behind on an account, that also will show as a 30-day late on your credit report, and 60 days the same, and 90 days, and so forth. So we want to make sure everything on the credit report is accurate. Now, if you have lates already on your credit report, the first thing to do is to talk directly to the lender to see if they would allow you as a customer service offer to remove it for you. Now, it's very low likelihood, but it's worth asking. You may have been with this company for a long time, and so it's worth the request. If they won't, you still want to pay it off. Pay it off, get your account totally current. The way that the repositories rate you is in 6-month increments up to 24 months. So the most recent late you have is the worst you can have. The farther behind you the late gets, the better and the impact, and the less the impact that late will be on your credit. Now, if you don't have open credit at all, you can go to your bank and go ahead and ask them to open something called a secure account, a credit card, where you put $500 into the bank and they freeze that money, or $1,000 into the bank and they freeze that money. And you can usually do it up to about $10,000, where they will then give you a credit card up to the amount that you are giving them. It's essentially a secured or collateralized account. If you don't make the payments, they keep the money. Okay, so that's one way to open credit. Another is to do car financing, which is a little bit easier to obtain. I highly caution you on secured accounts and car financing, especially if your credit is spotty, you're going to pay a higher interest rate. So when that happens, my recommendation is if you really have to have that car and you're going to go ahead and accept the higher interest rate, make the payments on time for the next 12 months. After 12 months, you may qualify to refinance and get a much better interest rate on the car. And at that point, you'll have some credit that's now positive and showing on time. The same concept applies to secured credit cards. So when you do this, it's always important that you manage and maintain your credit rating, making at least the minimum payment every month. If possible, pay more. Paying extra shows that you're not only managing the debt, but you're managing the debt with room to spare, and that is a very good thing for your credit score. So when we analyze, we're always looking for accuracy of the data on your credit report, whatever may be negative on your credit report, and the first thing we do is see if it can be paid off. Now, there's one more move here. You can sometimes negotiate to have them remove the negative off your credit by talking directly to the creditor. That doesn't happen very often, but it is worth asking about it and see if you can pay them or pay them off and get it removed off your credit. And a credit letter can be used by the repositories to remove that off your credit, and then you have a chance of your credit score going up quite a bit. If you have more questions, please feel free to ping us here and or call me at my office or email me, and I will walk you through how your credit report looks. Hope to hear from you soon and appreciate you watching.